I'm here live. Sir, instance.
Good evening, all, and it is a very happy occasion for the Southern India Regional Council of the Institute of Chartered Accountants of India to conduct a program which is of very much importance as we have to analyze today the direct tax and indirect tax proposals of the Union Budget 22. And we have with us the one and only teacher, administrator, past president, CA R.Bhupathy with us, because I am very happy to inform you all that I was one of the proud students of him, and I very warmly welcome Bhupathy sir for today's session, who is here to analyze the direct tax proposals for all of us. So warm welcome to you, sir, on behalf of SIRC of ICAI. I also welcome the moderator for the day, CA Subhashini Ganapathy, who will be moderating both direct and indirect tax speakers and connect the members with the speakers to see that the subject is well understood, well reached to each of the audience. And today we have also another great speaker, Advocate K. Vaitheeswaran, on indirect tax proposals, who will be joining in a while from now. And my council colleague, Mr. R. Sundarajan, also is there. I also very warmly welcome Mr. Sundarajan, sir. Warm welcome. Warm welcome to Subhashini Madam also, and all the attendees of this program who have already gathered in very good number. A warm welcome to all of you, and SIRC is very happy to be part of this program, because yesterday only the budget is presented, and we will be having two sessions for today. One on direct taxes, which will be taken over by R.Bhupathy sir, and later Vaitheeswaran sir will take over on indirect tax proposals. The queries, if any, can be sent through the chat box. Accordingly, the same will be taken up by the moderator, Subhashini ji. With this warm welcome, I hand over the proceedings to Mr. Sundarajan and request him to introduce formally Bhupathy sir to the audience.
Thank you, sir. Respected Chairman, SIRC of ICAI in absentia, Sri Jalpati sir. Respected past President of ICAI, Sri Bhupathy sir. Respected Sri K. Vaitheeswaran sir, who is likely to join now, advocate by profession. Respected Secretary, SIRC of ICAI, Sri Phanaraj sir. Respected Srimati CA Subhashini Ganapathy Madam. Respected viewers of this program, Namaskaram. Every year, our Finance Minister with her team prepares the budget and halwa, but presents only the budget to the Parliament. While it is ritual for a layman, our SIRC takes this as an opportunity to analyze and decode the budget, not only for professionals, but also for public to understand. The budget was presented yesterday, and here is our Guru, Sri Bhupathy sir. I think I'll be telling very small thing about him, because he is such a big man, and he is also my Guru. Let me just give a small brief about him. Sri Bhupathy sir is a product of Hindu High School, Triplicane, Chennai. He is a commerce graduate from Vivekananda College, Chennai, and a fellow member of the Institute of Chartered Accountants of India. He served as a research person in taxation in various professional institutes in southern India for more than 4 decades. He had made a presentation in the Union Budget in most of the chapters of ICAI in GCC countries and the professional bodies in the rest of the globe. He served as a member of the Central Council of ICAI for a period of 9 years and occupied the highest position of President of ICAI for the year 2003-2004. He is the chairman of Georgette Financial Services Private Limited and an independent director. Recipient of the following awards for his singular contribution to the accounting profession: Paramacharya Award and a certificate award given by Confederation of Asian Pacific Accountants. Thank you, sir. I'm introducing. I'm only telling about a very small thing about you, sir. And now the forum is yours, sir. Thank you, sir. Thank you so much, sir. We are all blessed with your presence, sir.
Thank you. Shall we start now?
Yes, sir.
Yes, sir. Let me thank the chairman in absentia, C.A. Chalapathy, Secretary C.A. Panaraj, Sundararajan for the kind words he expressed about me, Subhashni, the moderator for this session, and all other regional council members, re-elected, elected for the first time. The best of everything in your life. I personally thank you for extending an invitation. I have done this budget session for the SIRC many times in the past, and it's my pleasure to once again reconnect with all of you, and not only to the CA fraternity, but this being a public meeting. We have teachers, we have college students, we have resource persons, we have public also. Therefore, it's a very special event to analyze the provisions relating to direct taxes in the Union Budget 2022. With this brief note, I would just share my screen and then take you through the presentation. Is it okay?
No, sir, still not visible.
Is it coming?
No, sir, no, sir. You need to share the entire screen, sir, and then you can put it in slideshow.
Meeting.
Is it coming now?
No, sir, no. No, just you can see, stop the, if at all PPT is turned on, stop it off and click on the share screen button, so it should be.
We know as public Union Budget 2022, there are no change in the individual taxation. I think that brings in a kind of disappointment in everybody, but that is not all about budget. Though the common man expectation in terms of a budget, the moment we call it, finance minister is going to present the budget, the expectation is about indirect taxes, but there is much more to it. R.Bhupathy sir will take us through.
Yes, visible, sir. Now you can.
Visible?
Yeah, visible, sir. You can put it on.
How to remove this one? There's something coming in.
We can see it fully, sir.
Okay. The finance minister presenting her fourth budget would have definitely, with the help of all her colleagues in the finance department and all over the government, analyzed the current economic situation that our country, India, along with the other countries in the rest of the globe, is just now coming out of the pandemic. We have not completed our recovery stage. We are in the process of recovery. At this point of time, when a budget is being presented, there are many challenges which the government of India faced. I would only like to list out the challenges which we have seen for our country as a whole, and as discussed by the industry specialists across India. What are the challenges? Certain sectors were very badly affected because of the pandemic. For example, the travel and tourism, logistic, MSME sectors, and they all required some sort of energy, some sort of a boost, some sort of incentives for them. The manufacturing sector also required some help and support. There was an urgent need for employment generation because many people were affected. And at this point of time, we had conflicting views. The government, on one hand, was claiming that in spite of the pandemic, we were growing at a steady rate and there is nothing to be seriously concerned about. We are on the right path of recovery. But analysts have said that this performance was at the higher income group who are doing extremely well, but the lower income group and the middle level income group were finding it difficult to make both ends meet. Therefore, there is a small difference of opinion between what the government claims and what the analysts try to say. So if you see, most of the industries who came on interview before the announcement of the budget have confirmed, excepting for a few industries, that the private investments in companies have not geared up to the extent required. Therefore, there's a need for resource mobilization. These are the, challenges. Only a few of them, important ones, I've listed here. Against this backdrop, and if you see over a period of years, right from the year 61, when the Income Tax Act was formed, and even prior to that, the Income Tax Act was used as a tool to navigate the progress of any country. In India also, it was used, certain incentives were given to navigate the progress of the country in a particular direction. If a particular segment requires some support, some concession will be given in the Income Tax Act. But that trend is slowly vanishing. No longer the concessions are sought to be given through the Income Tax Act. The concessions are given directly. And that is what has happened in this budget also. Although the expectations, as mentioned by Subhashini, was very high, it did not really happen that way. The type of concessions which people were anticipating for boosting the manufacturing sector has not really come up. But against this backdrop, you will find after the finance minister presented the budget speech, she came on record to say that the GST collections for January 2022 was a very high figure and satisfying number. So this is a good indication of the progress of the economy. So we have all these things into consideration. And with this background, we will now analyze the direct taxes proposal. The first one, as Subhashini mentioned, no change in tax rates. All of them, if you read the newspaper over the last 10 years, each one segment have asked for increase in threshold limit or reduction in tax rates. But many developing countries would not like to increase the threshold limit because the number of taxpayers will get reduced. If the number of taxpayers gets reduced, that is not a good sign of a developing country. Hence, the threshold has not been raised and the tax rates also have not been reduced. But one thing which is very important, and I would like to stress on it, this is a very important amendment, a very significant amendment. We have something known as association of persons. What is this association of persons? Whenever our companies take a global tender, participate in a global tender, 3 or 4 companies come together and quote for this tender. And when they quote for the tender, they get the assignment. And when they are assigned this job, they execute the job as an association of persons. 3, 4 companies joining together as an association of persons. Their surcharge was as high as 37%, depending upon the slab rate of income. But now the finance minister has capped it to 15%. The surcharge of these companies will come down, and that is a good measure for these type of companies who take high-profile contracts, global contracts. This is one thing. Second thing is surcharge on long-term capital gains on assets has been capped at 15%. You will all know that long-term capital gains on sale of shares, the surcharge was only 15%, is only 15%. But for other assets, it was high. So now, even for the other assets, the surcharge has been capped at 15%. So the maximum surcharge could be levied is 15%. So these are the two changes in the rates of tax. And now we come to a very important one known as voluntary tax compliance, various provisions. The first one is regarding facility to submit updated return. A section has been introduced known as 139.8A. 139.8A. So what it says is a new term. This is a new term which has been introduced, updated return. We have return, revised return, belated return, defective return, and added to this, we have an updated return. That is, within the period of 2 years from the end of the relevant assessment year, if you have not filed a return for an earlier year, you could file a return right now and pay the taxes. This is what is the facility. Earlier, the time limit was up to a particular level. Beyond that, you cannot file a return. For example, for the assessment year 1920, you cannot file a return today. But because of this facility, you could file a return before 31st March 22. Now, this is a facility they are given to you. They say it's a facility to file an updated return. Let us see and let us analyze whether this is really a facility, whether there will be many takers for this type of filing updated returns. Now, there are certain categories of people who are prohibited. Prohibition of filing updated returns. When we said updated return, frantically yesterday and today, a couple of calls we received saying that, sir, I forgot a return, file my return for March 19, and I have claimed some tax, TDS is there. Can I now file it and get a refund? Therefore, this section very clearly says those people who are going to file a loss return cannot file it, prohibited. Those people who are claiming a refund cannot file it. And those people who are asking for extra refund than what was asked in the original return, they cannot file. There's a prohibition. Therefore, by using this facility, you cannot get a refund of tax. It will only result in outflow of tax from the assessee to the department. So to call it a facility itself is something which is not acceptable. Ineligible persons. There are quite a few people who are not eligible for claiming this, filing this updated return. Who are these people? The persons on whom a search proceedings has been initiated, a survey proceedings has been initiated, or his books of accounts or documents has been seized under section 132A. Those people are not eligible to file an updated return. This is the people who are not eligible. And above all, the most important thing is they have to pay an additional tax. In addition to the tax on the income which they are offering, they have to pay additional tax. Additional tax, if they file it within 1 year from the relevant assessment year, it is 25%. If they file it within 2 years from the end of the assessment year, it is 50% of the tax. When this provision was there, yesterday I received a telephone call from a gentleman who simply said that for the year ended March 19, he had a fixed deposit in a bank. The fixed deposit, he says, for the purpose of discussion, I will tell you the deposit was about 1 crore rupees. The interest on that, I have not included in my income tax return, and I have filed my return without including the interest on the fixed deposit. Can I now file my return, updated return, include that interest on 1 crore, about 9.5 lakhs, 10 lakhs of rupees, I will include the interest, pay the tax, and is it okay? I said it is okay, and let us analyze the situation. 1 crore means he is going to get an income of say 9.5% or for sake of calculation, an easy calculation, I will say 10%, he'll get 10 lakhs of rupees interest. On that, the tax rate, assuming he is the maximum slab rate, 30%, 3 lakhs of rupees tax, plus the interest for the delay in filing of return. That interest is not exempted. He has to pay the interest under 234A. And if he is a senior citizen, then he is exempted from advance tax. If he is not a senior citizen, he has to pay the interest for the delay in payment of advance tax, for the short payment of advance tax and the deferral of the installments of advance tax. So all these things put together, he has to pay, and the tax on that 10 lakhs will be 3 lakhs, plus interest will be about 1 lakh of rupees or more than 1 lakh of rupees. And plus this, and if you have not filed the return, you have to pay the late fee also under 234F. The late fee also you have to pay. Plus you have to pay 25%. This is the additional tax which you have to pay 25% if you are filing within 1 year. And if you're filing within 2 years, you have to pay 50%. Approximately, we calculated on the 10 lakhs of rupees, he has to pay about 5 lakhs of rupees as tax. If he pays 5 lakhs of rupees, then he could file the return, matter gets sorted out. Now, when we say out of an income of 10 lakhs, 5 lakhs is to be sorted, given to the income tax department. I do not know how many people will be coming forward to take this. So this is a thing regarding about the updated return, which is a new concept which has been introduced in this finance bill. Having explained that, now we go into the voluntary compliances. There are clarifications regarding 4 items, 4 very important items because of judicial pronouncements. And for once in this budget, if you see the memorandum explaining the finance bill, they have given detailed case laws for each of the items, for and against, where it is expenses allowed, not allowed, they're given. And for better clarity, they amended the sections. It all begins by saying for the purpose of clarification. Now, what happens is, all of you are aware that there's a provision in the Income Tax Act known as Section 40 small a1, which says that if you pay tax, the income tax which you pay is not deductible while computing your business profits. The income tax which you pay is not deductible. And you pay the cess and surcharge. When you pay cess and surcharge, people were claiming the cess and surcharge as what is they're not treating it as tax, and they were claiming it's a deduction, for which there are case laws for and against. And now they have put an explanation to this section, which says that for the purpose, tax would include cess and surcharge. Therefore, you cannot claim the cess and surcharge as a deduction while computing your business profits. Disallowance under Section 14A. Now, people get income which are completely exempted, and the expenses for earning the income is such income which is completely exempted are not deductible. Under Section 14A, any expense which is incurred for earning an income which is not chargeable to tax, that expense is not deductible. There are people who make some investments, and during the year, no income is accrued from those investments, but they have incurred the expenditure, but no income accrues. So what is the argument of the SSC is that since there is no income from the investments, the expenses are deductible, and they are claiming it as a deduction, for which they are relied on various case laws and the circular of the board. They interpret the circular, they include the provisions of law, and say when there is no income accruing from such investments, the expenses should not be disallowed and should be allowed as a deduction. Now they have said, even if there is no income from the exempted category of investments, the expense will not be allowed as deduction. 14A will apply, and such expenses will be denied deduction. This is a very specific clarification they are given, explanation. But one thing which is important is, as far as this treatment of cess and surcharge is concerned, they have made it retrospective from 1st April 2005. Cess and surcharge is a retrospective amendment. Therefore, all the earlier years, it will have an impact. But disallowance under 14A is only from the current year almost. Disallowance of business expenditure. Okay. There are certain expenditure which is an offense under any other law. If it is not permitted under any other law, such expenditure will not be allowed as deduction. But there are certain expenditure which is not, there are two amendments in this way. One, the section has used the word which is prohibited under any law in India. The section was worded in such a manner that if it is expenditure which is not permitted under any law in India. So if it is violation of any law outside India, then this section, disallowance will not be applicable. That's the interpretation that people do. Therefore, they clarified it for us. Whether it's a violation of any law in India or outside India, the expense will not be allowed as a deduction. That's one clarification. The second clarification is there are certain expenses which are not permitted because of certain practices and because of some regulatory bodies saying that it should not be allowed as a reduction. So if you incur such type of expenses also, it will not be allowed as a reduction. There's a clarification which has been introduced in section 37 of the, these are all clarifications and saying that the expenses will not be allowed as a reduction. The fourth and the last item for which a clarification has been given is that what happens is when you take a loan from NBFC or a bank, the interest on the loan is deductible only when it is paid in accordance with terms of the agreement, or it should be paid before the due date for filing of return. But in case it is not paid, that interest is not deductible. That is the section which is clear, there's no doubt about it. But what happened was, when difficult circumstances, the assessee goes to the NBFC or to the bank and tells him, see, this is what is my problem. I am running through a temporary difficulty, temporary financial problem. Hence, I am unable to pay the interest now. Why don't you fund my interest? Why don't you fund my interest? Thereby meaning the bank will convert the interest payable as a loan. There was a clarification which was introduced earlier saying that if you convert the interest payable as a loan, it will not be treated as actual payment and the interest will be disallowed. What they have done is, some companies, in order to overcome this difficulty, instead of taking another loan to fund the interest payable, they converting the interest payable to loan, they used to take secured debentures or debentures and repay against the interest payable. They'll issue debentures against the interest payable. And when they are issuing debentures against the interest payable, they're saying that it's not a loan, and hence the disallowance under 43B will not apply. Now they have also clarified, even if you take, issue debentures for the interest payable, then also it will be considered as the interest has not been paid and the provisions of 43B will be triggered and the interest will not be allowed as a deduction. So all these clarificatory amendments, the first one is retrospective, the next three are prospective, and they have clarified the intention of the government in very clear terms that the disallowance provisions will apply. So this is a significant amendment. And then we'll come to the socio-economic measures. This is a very important one. I told you the finance minister has to consider the economic aspects in the country before announcing the budget. Now, manufacturing companies were given a concessional rate of tax, lower rate of tax, and they had to start the manufacturing or the incorporation of the company before 1st April 22. And you all know the last 2 years was a difficult period. And hence the finance minister has extended and given 1 more year time. They could start before 1st April 23. And once they start before 1st April 23, they will continue to get the concessional rate of tax, which is a good amendment for the manufacturing sector. Then tax holiday for startup. Startup, you know, startups are very important for the country. There was a tax holiday introduced for the startup companies. That is, any profits they make for 3 consecutive years in a block of 10 years, are completely exempted from tax, provided they start before 1st April 23. Now they start before 1st April 22. Now they are extended it by 1 year, and they said if you start before 1st April 23, that tax holiday for a 3 years period, 3 consecutive years, whatever profits they make is completely exempted from tax. Supposing first 2 years they incur a loss, they need not claim the benefit, and some 3rd year onwards they can claim it for 3 consecutive years. This is now alternate minimum tax on, this is a very small amendment on cooperatives, reduced from 18.5% to 15%. This is to bring parity. Corporates were paying minimum tax at 15%. Why should the cooperatives pay tax at 18.5%? So they brought cooperatives also on the same threshold of 15%. Now we come to an important one. Maybe it's not affecting the common man, but it affects India. And it is a significant amendment. Hence, I'm taking a little time to explain this aspect. What is known as International Financial Service Center. In our country, we have International Financial Center in the state of Gujarat. We have already, it is functioning. You can Google IFSC and you will find so many companies which have been incorporated in this, IFSC facility, which is an SEZ, which is a special economic zone. Now, if you start an activity there, a unit, banks can start a unit, certain aircraft leasing companies can start a unit there, certain, so different types of organizations can function from there. Whatever profits they make in relation to the activities carried on in that unit is exempted from tax under Section 80LA of the Income Tax Act. So the profits are exempted. This is a very significant amendment to attract investment. And who could invest in this time? Non-resident can invest. I told you they have to mobilize resources. To mobilize resources internally from India, we have got our own challenges. So whereas people from outside India, where their return outside India is so minuscule, they are interested in coming to India and investing. Therefore, if they come through the unit in the IFSC, their profits which they make will be completely exempted from tax. And the government, in the finance minister speech, if I marry this idea with what the finance minister presented in a budget speech, the entire SEZ Act is going to be given a new avatar. They're going to come out with a new SEZ. When you come to new SEZ, and they have plans to have SEZs all over India, that is IFSCs all over India. And if that is going to materialize, so many units will come in and the profits are going to be exempt from tax. It will generate a lot of resources for the country, which could in turn propel the economic activity in India. This is very significant. Now, in addition to the unit getting exempted, see what happens is there's a bank in the IFSC, in the SEZ. If you go to the IFSC, Google that, you will find about 54 banks have already started their activities. And if a non-resident is going to do some offshore derivative instruments, transfer of offshore derivative instrument, or offshore banking in a bank with a banking unit in IFSC, whatever capital gains he gets will be completely exempted from tax. Just imagine he gets 1% return outside India. if he's going to put it in some offshore derivative investments and he's going to make some profit and he's not paying a single paisa tax in India, this will definitely attract people for investment in such type of derivatives, and they will get the resources. Second thing is very important. I told you the challenges, one of the challenges is logistics. Income of non-residents, royalty or interest on account of aircraft already is there. If you lease out aircraft, you get a royalty or interest, then that income is already exempted on 10F of the Income Tax Act. But now what they have done is they added the operation of ships also. Therefore, that's why I put it in red color. The addition is in red color, ship paid by unit of IFSC. A unit in IFSC engages a ship, takes a ship and charters a ship and pays some royalty or charter charges or whatever it is for the ship. That one, and that ship belongs to non-resident of India. The income which he gets will be completely exempted from tax. So we expect the logistic things to improve because of this. Exemption of income of portfolios here. This is another thing. If they're going to invest in a portfolio of securities through offshore banking in the IFSC, whatever income which they get from the portfolio of securities. The earlier one, it is only the capital gain on transfer of offshore derivative instruments. But this one is entire portfolio of securities will be completely exempted under 10(4)(g) of the Income Tax Act. So these are the three things to mobilize. IFSC is very, very important. If the government is able to execute whatever they are promised in the form of accelerating the process of creating NSI, IFSC in the SEZs, then this will be a real resource mobilization for the country as a whole. We could expect a lot of money to flow in this direction. Contribution to NPF, National Pension Fund. See, what happened was, under 80CCD of the Income Tax Act, if an employee of a central government contributes to the National Pension Scheme, he could contribute up to 14% of salary and he'll be eligible for, it will qualify for deduction under 80CCD. Whereas other employees, if they contribute up to maximum of 10% only, will be eligible. So there was a differential treatment for the central government and state government. Rightly so, the finance minister has said, even for the state government employees, they could contribute up to 14% of salary and it will be eligible, it will qualify for deduction under 80CCD of the Income Tax Act. This is another very on the socio-economic measures. Whenever an individual is having disabled dependent, for the maintenance and treatment of the disabled treatment, he spends some money that is eligible for deduction under 80DD, or he takes an annuity scheme with LIC and pays a contribution every year, and this amount would be payable to the disabled dependent after the lifetime of the individual. The individual who takes this policy, invest this amount, the scheme, after his lifetime only, the dependent can use this amount. So this is a hardship to the SSC. An individual has gone on a writ petition to the court and said, here is the money available in the scheme, and I am desperately in need of money. I am a disabled dependent, and why is it I should not be eligible to withdraw this money? Therefore, they amended the section that saying that you could withdraw it even when the individual is alive, and the benefits of 80DD will not be denied to you. You could get the deduction. This is a very important amendment on a socio-economic aspect. Okay, this is a very small amendment, but very important amendment. Many people were affected by COVID, and for medical treatment of them, the employer employer or anybody else, not employer, anybody else would help him for the medical treatment. Now, we have a provision in the Income Tax Act, Section 56 of the Income Tax Act. If somebody is going to get a gift above 50,000 rupees in a year, and the amount of receipt will be treated as income and chargeable to tax. Here is a person in distress, and he needs money for treatment. And some benevolent, some would say person with a generous heart is coming forward to give this money, and you have to tax this person in distress. It's unfair. Hence, they have said that whatever amount which he receives for medical treatment is will be eligible for exemption. It will not be chargeable to tax. It will not be subject to the provisions of Section 56. Similarly, if the employer incurs expenditure, it will not be treated as a perquisite for the employee. These are all very small amendments. Therefore, I'm not going to spend time. Now we'll come to, these are repeats. So this slide was repeated. Widening tax base. Quickly, I'll run through this widening of tax base. TDS in case of payments to specified persons. Now, when you are deducting and making payment of tax, you have to deduct it at a particular rate. The section provides at what rates you have to deduct. However, in these two sections, 206AB and 206CCA, that is tax deduction, tax collection, and so on, they have said, in case the person to whom you have paid, to whom you are making payment, has not filed his returns for the immediately preceding 2 years. He has not filed his return for the immediately preceding 2 years. How will I know that he has filed his returns or not? I will come to it. And the second thing is the TDS for each one of the years, each one of the 2 years exceeds 50,000. Then, instead of deducting tax at road at this, but they have to deduct tax at higher rate. This is existing provision. What is the change? What is the amendment? The amendment is they have reduced that 2 years to 1 year now. How is it? Assuming I'm going to make payment to a works contractor, and he has not filed his return for the preceding 1 year, and his TDS is above 50,000, then I have to deduct tax at source at higher rates. So instead of 2 years, now they brought it down to 1 year. Now coming to the practical question, how will I know whether that person has filed his return for the last 2 years, last 1 year? They have provided a facility in our utility when we electronically submit our return. If you put the PAN number of the other person and ask question whether he has filed the return for the preceding 2 years, preceding 1 year, then it will top up, a message will pop up. Yes, he has filed or not filed. And if he is not filed, then you have to deduct tax at source higher rates. In other words, it is a complete delegation of what the department has to do by way of collection of tax is being delegated to the public at large to do it in a more effective manner. This is what is coming out of it. So this is a significant amendment to widen the tax base. And this is what the finance ministry is expecting. No increase in tax, no changes in tax rate, but they expect to mobilize more revenue. That is because the expectation of better compliance. Because of all these provisions and because of the electronic way of filing returns and collection of data, it is possible to. So this is what I said. Existing law, return not filed for 2 preceding years. TDS amount 50,000 for each year. Amendment period reduced to 2 years, from 2 years to 1 year. This is the. This is a small amendment. TDS on immovable property 194 IA. That is, you have to deduct tax at source on the sale consideration. The present section says only on the sale consideration. But you are all aware that in case the property is sold at a value less than the stamp duty guideline value, then it will be the stamp duty guideline value will be taken as the sale value. Therefore, TDS also, if the stamp duty guideline value is higher, then the TDS has to be made on the stamp duty guideline, either the sale consideration or the stamp duty guideline valuation, whichever is higher. The percentage has to be applied on a consideration or the stamp duty guideline value, whichever is higher. TDS on purposes of business or profession, 194R, new sections. And this is very important. I'm sure the chartered accountants as well as the business community people will be aware that many companies, in order to generate more business as a business promotion expense, give some sort of concessions to the distributors, to channel partners, to people who help them in their business. And they give sometimes gold coins, sometimes they give them free for foreign travel. Sometimes they give as big a thing like a property. They give certain perquisites, not to an employee, but to a businessman. Now, when they give a benefit like this, that benefit is chargeable to tax under Section 28 of the Income Tax Act. Whatever benefit a businessman gets during the course of carrying on a business or profession is chargeable to tax. So supposing to a distributor, I'm giving a car as a gift for achieving certain sales target, then the car is chargeable to tax as a perquisite for the businessman. The value of the car should be taken into account, and I should deduct tax at source at 10% on the value of the car, and then only give the car to him. But how could I deduct when it is in kind? Therefore, the law provides for it that I should somehow make payment of the tax, collect the money from him and pay the tax, or pay the tax out of my money, and then only give the gift. This is what is provided in 194R of the Income Tax Act. That is to bring in more compliance of the existing provisions. There is already a provision that benefits in the course of carrying on a business or profession is chargeable to tax. But unfortunately, there is no method to track it. Now here, the TDS mechanism, it is the responsibility of the person making the payment to deduct tax at source at 10%. And there will be a responsibility of the tax auditor who gives the report in Form 3CD, which says that all tax deductions has been complied properly. So if that is the case, there will be better compliance and better recovery of tax. This is also a significant amendment, depending upon the order of the day. These are developments which are taken place. Previously, if a cinematography film, a producer, after he completes the production of the film, within 30 days, he has to give details of the expenditure incurred in a specified form to the Income Tax Department. He has to give it so that they could track it immediately. They need not wait till the end of the year and filing of return and all. After the completion of the production, within 30 days, he has to. Now that section is being enlarged by adding not only cinematography film, but also manager, event manager. Today, event manager thing is a very common phraseology in the sense there are so many types of event managers. Production of documentary and programs. So if you are going to do certain things like this, and if you incur expenditure, you also, the event manager, the production of a documentary, or the person who produces a program, all these people, within 30 days, they have to give all the details to the Income Tax Department in the prescribed form. Bonus stripping extended to units of business trust. You invest in bonus, you invest in the units, shares and securities, and or units, and then what you do is you get the bonus, and afterwards you sell off the existing units at a lower price. You'll get a capital loss, because once the capital base is expanded, the value of the units, value of the shares will fall. You'll get a capital loss. 94(7) existing section provides the loss to the extent will not be recognized. To the extent of dividends will not be recognized. So this was not applicable in the case of units of a business trust or units of the real estate investment trust or alternate investment fund. Now in this budget, they have included, if you buy units of a business trust and within 3 months you get bonus, and then within 9 months you offload the original units, then this provision will apply in respect of the units of business trust, real estate investment trust, and alternate investment funds. So they expanded the scope. Now we'll come to revenue mobilization. Now this is very, very important. I'll just take 5 minutes to explain this and be done with it. I know I am just overshooting my time. I have come to the penultimate slide. So what is important here is something known as NFT. What is this NFT? Non-fungible tokens. You just Google NFT and you will find quite interesting things which are happening in our country, the globe. Amitabh Bachchan net series records highest ever bid of $1 million. This is in the form of an emblem or a design or a number, which is transferable in a digital mode. And they get $1 million. Second, Beeple is a company. Beeple sold an NFT for $69 million. $69 million. And there is no effective tax provision to take care of it. This was floating around in the news last 1 year. There is, what's say, uncertainty, the tax provisions of this. So this is something which a new area which is emerging, a new business model which is emerging. People, there's a software. You go into it, you develop your own design. Real estate, NFT for real estate companies. New things have come. So these are saleable in the form of a digital mode. So what they have said is, they have brought it within the definition of capital asset. They brought it within the definition of capital asset, and they said these are all called virtual digital assets. And if you are going to sell it, or if you're going to lease it out, and you're going to get some income out of it, it will be chargeable to tax as capital gains, and it will be chargeable to tax at first the definition of capital asset. They brought it 115 BPH rate of tax is 30% of income without any deduction other than cost. Only the cost of developing the virtual digital asset, that is deductible. No other expenses allowed. 30% of that will be chargeable to tax. It's sizable revenue, good revenue. Instead of going and taxing small people, these are the people who make high level income, and they could afford to pay this type of tax. And rightly so, 30% tax without any, because it's a one-time expenditure for them. Once they develop, they could monetize it over and over again. So if that is the case, the 30%, and there's a TDS provision to ensure compliance, TDS of 1% of such. If you gift these digital assets also, and if it exceeds 50,000, in the assessment of the recipient, it will be chargeable to tax. Instead of getting a consideration, if you gift it, it will be chargeable to tax. These are the, this is a very good revenue mobilization measure. Very good revenue mobilization measure, which I have only one slide. I know I'm cutting into the time of Vaitheeswaran. So what I will do is, I will stop here. The one point which I wanted to say is rationalization measures. These two I am not telling. And what is specifically excluded in my presentations, amendments not covered in this presentation, phasing out of exemptions. Slowly the exemptions are being withdrawn. I have not covered that. Regarding assessments and reassessments, I have not spoken about it. And faceless assessment, I have not touched about it. And charitable trust. These 4 areas I am not able to go because 50 minutes to 55 minutes was the time allotted. Therefore, I will stop here with the expectation that if there are any specific questions, I'll be only too happy to answer to the best of my ability. Thank you very much for the very patient listening. Thank you very much.
Thank you. Thank you very much, sir. I think you will stay back for the question and answer sessions.
Yes, I'll be.
Yes, sir. Yes, sir. Please, sir.
There are a lot
very warm
of
welcome to. Yeah.
So there are a lot of questions in the chat box. Probably like I would suggest we can take both the questions of direct tax and indirect taxes together. So despite the concerns in terms of retrospective amendments, I think the fact which we have to accept is the government is listening. Over to you, Panaraj.
Good evening, all, and the session will move on. We will move on with the sessions, and now we are going to have the indirect tax session. A warm welcome to Vaitheeswaran sir. Sir, I think we could not welcome you because you joined a bit late. As Secretary of SIRC, on behalf of the SIRC and on behalf of my chairman and all the office bearers, a warm welcome to you, sir. And we're all eager to hear both of you. And a lot of people who have logged in on YouTube, and it is also there for public in addition to the members of the institute. So a very warm welcome to you, sir. And before you take over, I request our regional council colleague, Sundarajan sir, to formally introduce you. Over to Sundarajan.
Namaskaram, sir. Vaitheeswaran, sir. Namaskaram. Yeah. Sri Vaitheeswaran, sir, is obtained a law degree from the Madras Law College and enrolled as an advocate in 1990. He also has obtained grade CW from the Institute of Caste and Works Accounts of India and has completed ACS from the Institute of Company Secretaries of India. I think you have left out our institute, sir. His legal firm operates with physical office in Chennai and Bangalore and provides services virtually across the country. He has over 31 years of experience in advisory capacity, as well as through appearances before appellate authorities, tribunals, and courts in matters arising under domestic and international tax laws, excise and customs, service tax, VAT, CST, GST, FEMA, RERA, company law, and IBC. He is considered as as a specialist in tax and legal matters with in-depth knowledge of business and tax laws. Thank you, sir. We expect more presentations from you and a good guidance from you for this session, sir. Before you start, I would like also to introduce Subhashini Ganapathy, who has been helping us in this program also, and also in the earlier programs of SIRC. Subhashini Ganapathy is a specialist in direct, indirect, and international taxation, as also a qualified forensic auditor. Accredited faculty by Institute of Chartered of India, Ministry of Skill Development, has been a part in the initiatives in GST awareness by Tamil Nadu government and ICT Academy. A faculty member in DTRTI, training the income tax officers and officials of the income tax department. Also trained the GST officers on various topics. And she has been so helpful to us. Welcome, Subhashini, to this program. Sir, the forum is yours, sir. Thank you, sir. Thank you so much.
Thank you very much. And let me first try to share the screen. Yes. So good evening to all, and it's a pleasure to be part of SIRC's annual exercise. Normally, this budget analysis happens on the day of the budget, and there are many occasions where we and Bhupathy sir have rushed to the physical environment in Nungambakkam at 6 p.m. to address the fully packed gathering with people sitting on the doors and windows and standing and listening. And in a way, we don't have to torture the delegates and the members in that format. Being a virtual meeting, everybody can attend to this in their own comfort zones. So pandemic, while it had its own disadvantages, from a virtual meeting perspective, it has really opened up the vistas as far as attendance is concerned. So thank you once again to SIRC for giving me this wonderful opportunity again. And I had the pleasure of listening to Bhupathy sir. It's always a pleasure to listen to sir, and the way he meticulously dealt with each and every aspect of the provision, including the logic and the rationale behind the amendment. Now, My presentation would be structured in a different format. While it is quite common to have a technical structure, I would like to keep it on a lighter format because the budget is a very serious document. There is so much of English and verboise in the budget that people are getting tired, and people have listened to all kind of stuff from morning in the news channels, and they've read enough journals. So I try to keep it light. The objective of this is to just to package tax with humor and nothing else. So the disclaimer is there for all official purposes. This presentation would use web content, would use titles, would use comedians' images, only for the purpose of adding humor for relevant segments of this budget. And all SOPs have been followed while preparing the presentation. And if I may add, so no animals were harmed while making this presentation. And my standard disclaimer is this: understanding amendments is injurious to health and contributes to wealth. And all reference to decisions are real and not imaginary. And I put a caveat by saying this presentation is prepared on 1st February 2022, because by the time Finance Bill becomes Finance Act, we have seen many occasions where changes take place significantly. And some of the new ones would come and completely erase whatever has been said in the Finance Bill. Therefore, I would like to qualify and say that this presentation is prepared on 1st February 2022. Now, first, I look at the numbers. See, everywhere people are talking about some kind of, barbad, everybody is gone, business is gone, there are no sales, COVID has impacted, COVID wave 1, COVID wave 2, everything has gone, etc. But take into account the fact that there is significant evasion. And despite the evasion, you look at these numbers from the organized sector. The corporate tax collection was budgeted at 5,47,000 crores. Revised budget estimate was 6,35,000 crores. And actual collection is 7,20,000 crores. Normally, you see a reverse trend. You budget for 100, revise it to 80, and then collect 60. But this is the other way. You budget for 5,47,000 and then end up at 7,20,000 crores. Individual income tax, your collection is 6,80,000 crores. Customs duty, your collection is 2,13,000 crores. Excise, of course, a legacy tax. Service tax, again, a legacy tax. CGST is very interesting. Budget estimates was 5,30,000 crores, revised to 5,70,000 crores, upward revision, and then actual collection is 6,60,000 crores. It's a huge collection as far as revenue numbers are concerned. So I would say that the government should be in some kind of comfort zone as far as tax collection is concerned, because the revenue resource mobilization has been fantastic. So I'm surprised by some of the amendments where they keep on trying to say we want to track these transactions, we want to shift the onus, we want to shift the liability, because you're doing well. So why should there be so much of upsetting the apple cart? The finance minister's speech was very interesting in the sense that there was a reference to 100 years of India in 2047 and how some of the decisions are taken in that context. So you will find some of this in the budget. You will find some of the amendments are effective from 1/4/22, 1/2/22, 1/5/22, 1/4/23, 1/9/23, 1/10/23. These kind of changes are also there as far as indirect tax is concerned. So people have to be smart and alert in understanding when those changes are coming into force. So I'm sure Mr. Bhupathy, you have covered, I came and joined a bit late, but you have covered the personal taxation. So what was the market expecting? People are expecting relief in the sense that individuals, the retired person who's staying at home, who's put his money in a fixed deposit, which a dwindling interest rate, which had once upon a time of 9% rate and dwindling at 4.5 and 5.2, etc. That person, all he wants is some kind of cash in his hand, some kind of money in his hand. So people are looking at salaried sector was paying significant amount of taxes. COVID has really increased expenses across the households. So people are looking at some kind of SOPs, and one of the typical SOPs was the slabs getting altered, or some kind of rebate changes happening in direct taxes, or GST reduction. None of them happened. No reduction in GST rates, no new exemptions, no big ticket reductions in customs, but luckily no new cess also. There was also a rumor that there would be a COVID kind of a cess, but that didn't happen. And therefore, to some extent, we need to be thankful for that. I'll give a different perspective of umbrella. Of course, the social media has gone agog on this umbrella. You have memes which said that why is umbrella being subject to a low rate of duty, higher rate of duty, while diamonds are being subject to low rate of duty? Is it fair? People have not understood this. And to some extent, communication is also not that great. Why is customs duty on umbrellas going up? It is not only umbrella, it is also parts of umbrella. Therefore, when duty on an output goes up and duty on parts of that output go up, what it automatically means is that there is a potential for the local market to fill in that gap. So local production would be encouraged, manufacture would be encouraged, Atmanirbhar would be encouraged, and people would ensure that the local market is not crushed by cheaper umbrellas that come from abroad. So this is probably why there was an increase in custom duty as far as umbrella is concerned. But as far as the diamonds are concerned, the position is slightly different. The sense that you have a scenario where the raw material that is required, unfinished stones that are required to make a finished product, finished diamond, polished stones, which are exported. If the duty on the raw material comes down, it is good for the exporter. And therefore, it makes tremendous sense to reduce some of the materials which are involving in the diamond export business. But umbrellas always has a checkered history. When excise duty was there, for some reason, there is always a reference to umbrella in the budget speech, because the budget speech only picks up some of these items. Most of these items are notification amendments. Only notification amendments are read by the industry, the manufacturer in that segment, and the professional who advises in that segment. But if it comes in the budget speech, it becomes news. And for some reason, umbrella has always been in the budget speech: 89, 94, 97, 2002, 2003, 2006, 2007, 2010. And after that, there was a complete quietus. Probably there were no rains. And 2022, umbrella is back in action. Duty has gone up from today in respect of all these items: microbial fats and oils, imitation jewelry, loudspeakers, headphones and earphones, smart meters, solar cells, solar modules, etc. Please understand, these are only custom duties that have gone up. There is no impact as far as GST is concerned. This is what I talked about. Whoever is in business or whoever is in advisory in the context of this kind of industries should alert the businesses that there is a massive change that is happening across customs rates. Customs tariff is getting altered. Various notifications are getting rescinded. Various notifications are getting partially modified. There is a clear picture, but good thing about this is that the government has given a very clear picture instead of saying that we will notify from that date or from that date, etc. They've painted the full galaxy of changes and have indicated box-wise as to which change is effective from 2nd February, which changes from 1st of April 2022, which is effective from 1st of May 2022, which is from 1/4/2023, which is from when do you have sunset clause and exemption notifications, when amendments are made about technical changes, where the entries are partially modified, where obsolete notifications are rescinded. Everything has been captured. You need to spend some time. It's a lengthy document. It's available on the website of the CBIC. You need to go through it to understand whether your products are getting altered or affected because your structure, your pricing, etc. can change. Textile sector, you all remember that GST Council had proposed that the textile would be subject to a high rate of 12% to 5%. The reason that was given at that point of time was that it would solve the effect of inverted duty structure. But ultimately, there was tremendous amount of objections across the public and society as well as industry that textiles should not be taxed at a higher rate. And for the council also felt, and in the last moment, it was kept in abeyance. So there is no change. GST continues at 5%. But what is happening is that there are a lot of tariff changes in customs for textile sector. The effective rate change for certain items is also happening. Some of these are effective from a cutoff date. A number of exemptions are getting withdrawn from 1/4/2022 and some from 1/4/2023. So this sector should again, as I said, carefully note some of these amendments and be ready for the impact in terms of their pricing. This is what I talked about. Simply sawn natural diamonds import under Kimberley process reduced to 0. Cut and polished diamonds reduced to 5%. Cut and polished natural gemstones reduced to 5%. And these are all amendments which are required in the context of that industry which is exporting. Huge impact in project imports. From 30th September 2023, all project imports will be only at 7.5%. Between that period, there are some changes which you need to factor in terms of your time frame and things like that. Now, these are, I just went on to a PPT mode and explained all these things, but now I'll just step back a bit from the slides and talk about what is the issue. All of you are aware that the tax administration is structured in different modules. There is an assessment officer, there is an assessment function. Sometimes you call it adjudication. In income tax, you call it income tax assessment. There is an intelligence wing. There is an investigation wing. Now, for indirect tax purposes or general investigation purposes, there is something called as DRI, Directorate of Revenue Intelligence. It's a very powerful body. This body is given certain objectives of unearthing major evasions which can happen in the country, and they are given a lot of resources, their technology, their inputs, their intelligence is significant. And the idea is to unearth major things that take place. And they've done a fairly good job for years together. But if you notice in the past, the DRI would pick up few issues of major evasion, which will run into thousands of crores, which will be pan-India, which will be involving other countries and things like that. But off late, what has happened is that the DRI investigation has gone into specific individual SSCs, specific corporate, small businesses, other business, etc., any matter. So it virtually started functioning like some degree of an assessment to some extent. So the investigation would happen. And normally what happens in investigation is that the investigation data would be shared with the assessment function, and the assessing officer would do what has to be done if in case notice has to be issued. But slowly, the DRIs and the DGSTIs of the world started issuing show cause notice themselves. So after the summons, after the investigation, it culminated the show cause notice that was issued. So when show cause notice was issued by the DRI, the assessees challenged those proceedings by saying that the DRI is not empowered to issue a show cause notice. An adjudication or assessment or reassessment function can be carried out only by an assessing officer. And under Section 28 of the Customs Act, it is defined as a proper officer. Only a proper officer can take such action. No other person can take such action. So this went up to Supreme Court. And in Supreme Court, the matter was decided in the case of Canon India. The Supreme Court held that show cause notice issued by DRI is not maintainable, as DRI is not a proper officer for Section 28. Power of issue of show cause notice must flow under that section that provides for the issuance of show cause notice. And merely because powers have been entrusted to the officers by the board, that does not pass muster, and that is not enough. So in effect, there were notifications that said that the DRI can act as an officer for the purpose of so and so for functions on the Customs Act. But despite that, the Supreme Court said that that is not enough. If Section 28 uses the word proper officer, it is only that officer who can do assessment, or some other officer who is sitting in that post who can do the assessment or reassessment. It's very important. This is also relevant in income tax in the sense that you find that intelligence happens through another division in the income tax. Investigation happens to another division. Data will come to the department from various sources, but there is an assessing officer who initiates the action. And of course, 263 is a different kind of a scenario where it applies under certain circumstances. Or if you take VAT, there was an enforcement division, there's an enforcement department that would investigate, prepare the report, share it with the assessing officer, and then the assessing officer will do reassessment if warranted. So when the investigation wing itself decided to take up the show cause notice, the Supreme Court said no. So what the government should have done, in my view, is that they should have accepted, yes, this function is an important function. It cannot be exercised by everybody other than the assessing officer. There's a reason for creating such a power. But we feel that this officer can also do it. They should have done it prospectively. But instead of that, what the government has done is that they've tried to nullify this judgment. And in the process, they've gone through a series of amendments through the relevant sections, which are applicable, Section 5, the definition of proper officer in the Customs Act. And in that context, what they've effectively done is that they've also introduced the Validation Act. So what has happened is that Clause 96 of the Finance Bill 2022 seeks to validate action taken or functions performed under various chapters prior to the amendment. Notification assigning functions deemed to be validly issued. Section 2, 3, and 5 as amended deemed to effect for all purposes as if the amended provisions were enforced at all material points of time. But most important, pending proceedings on the date of commencement of this act shall be disposed of in accordance with the amended act, which means if a show cause notice issued by a DRI is pending adjudication and it is going to be taken up, then whatever action taken would get validity so long as this Finance Act is amended as such and the date and it is effectively brought into force. But if proceedings have been culminated in an order or the appeal has been disposed of based on canon judgment, then that would survive, because as on the date, as on the commencement of the act, there is nothing that is pending or pending proceedings are not there. The amendment is itself questionable in the sense that the provision says that the board can appoint a proper officer, and it goes on to say the proper officer can assign another person who can discharge functions, and that person will be the proper officer. It brings a simple question whether a delegate can further delegate, then whether the amendments are enough to get over the observations made by the Delhi High Court in the case of Mangali Impacts case, which is pending in Supreme Court. So fresh round of litigation cannot be ruled out. Scope of retrospective amendments would come into play for discussions. Scope of validation acts will again come into play for interpretation. But I would say that the last word has not been said as far as this canon and the amendment is concerned. Section 14 deals with valuation. And under the customs law, if there is an import and the transaction value will be accepted provided certain conditions are met, and the valuation is done through the valuation rules. The valuation rules are largely mirroring the WTO valuation rules, except for some extra points which came through Rule 12. Now, in order to get over a judgment of the Supreme Court in the case of Century Metal, there is now saying that valuation rules can be amended where additional criteria can be imposed through the rules, and these rules are a little bit extra in the sense that they can even look at trend of pricing and things like that. Whether that has an impact and whether those provisions will be compliant with the WTO valuation rules, we'll have to see as things move forward. Now, coming to GST, unbelievable collections. January itself, 1,38,000 crores, and the January collection of 1,38,000 crores is the highest from inception of GST. In fact, economic survey, which was present on the 31st of January, gives even more interesting data. The gross monthly GST collections have crossed 1 lakh crore consistently since July 21, after quickly recovering from a dip in June 21 following the second wave. What is more interesting is GST collections for center is at 61.4% of the budget estimates during April to November 21. That means what? Huge chunk of the budget estimates is coming from GST for the center. Rest is only petrol and excise duty on petrol and customs duty and income tax. So which means 61.4% of budget estimates, if it comes from GST, then the government should be really happy with the fact that GST is doing well. But is the collection only because of the fact that GST is doing well? We need to do a microscopic study. Whether we need to see, because if you look at the next line, ongoing improvement in revenue performance during current year can also be attributed to increased tax compliance enabled by various tax administration and policy reforms. Yes, there have been policy reforms, no doubt about it. GST rates are changed significantly to help the industry, no doubt about it. But whether the increased tax compliance is on account of administration exercises or much more than that. I know for a fact that there are a lot of businesses who have not claimed input tax credit, even though they could be eligible to claim input tax credit. There are a number of cases where credit is not reflecting in the portal, and therefore they're thinking that they cannot take it. There is even a case where the assessee went to Supreme Court saying that it was not there in the portal, and therefore I could not take it. But Supreme Court said it was there in your books. Why did you take it? That's a different story. But it's also a fact that import data mismatch is there. There are cases where blocking has happened where you're not able to utilize your credit. So when you're not taking credit effectively, or when you're prevented from getting credit, or when you're blocked from using the credit, what happens is that you will pay in cash. You will pay significant GST in cash, which is not a good idea, because the beauty of GST is the input tax credit. So one significant amendment has come. In my view, the selling point of GST, or even the 101st constitutional amendment, if you look at the preamble to the 101st constitutional amendment, the objective was to eliminate cascading effect of taxes. To eliminate cascading effect of taxes. The objective to eliminate cascading effect of taxes is summarily defeated by two amendments. One is 16(2) amendment that came from January 1st, 2022, and the second amendment that is going to come from the Finance Bill 2022, when it becomes Finance Act 2022, and all other states also make this respective amendments. What are they saying? ITC can be availed only if credit has not been restricted and the details are communicated to the taxpayer under Section 38, which is GSTR 2B. So from now on, after these provisions are implemented, your ITC is going to hinge upon an automated or auto-populated tool, which is going to tell you, this you can claim, this you cannot claim. So let's imagine something like this. You're having 1,000 vendors. If you're having 1,000 vendors, how much of research will you do? You will do to the extent of material being matching your quality, material being matching your parameters, material being delivered in time so that your just-in-time requirements are met, your production process goes smoothly. To some extent, you are sure that fellow will not run away, and therefore you give him some advance, and then business cycle goes on. Now, what it says is, and you look at whether he's registered, his GST number is valid. He raises a valid GST invoice, he charges 1 lakh as price, he charges 18,000 as GST. You make payments to him, you are very prompt, you make 30 days, you make the payment to him, he is happy, you are happy. Now he plays prompt. He delays in filing his return. He violates some provisions and not pays a tax. He does not upload certain returns. His fault drives the department to you. Earlier, Mr. Bhupathy sir was making a point in the context of the onerous requirements in the context of TDS, where the TDS rates would double in a scenario where the person to whom you are making the payment has not filed his return. If a person to whom you're making payment has not filed his return, then the authorities and the government should go behind that person and make him file the return and collect the taxes. Why collect, double rate from the double rate as TDS and keep quiet about the whole transaction? So the onus is shifting to some extent in an onerous manner. So a buyer should now be looking at what is coming as 2B, which would mean that significant amounts of credit may not be there in 2B. There would be a list which is eligible, list which is not eligible, which will come from 2B. If you look at 39, 38 and all those things, you'll understand this better. So what happens is that you might have spent 1 crore. You might have taken 18 lakhs as input tax credit. You might have paid the vendors 1 crore with 18 lakhs, but your 2B does not give 18 lakhs. It gives you only 12 lakhs or gives you only 10 lakhs. Then that 8 lakhs which you don't get the GST credit becomes your cost. If it becomes your cost, it contributes to cascading effect of taxes. You pay tax on tax, your pricing goes up. So the overall benefit of GST is likely to be significantly derailed if these amendments are implemented in total. So why is this amendment done? The amendment is done is that government is saying we did not collect the tax from some of those 1,000 vendors. 200 vendors have not paid the tax. GST is common for all. It is common for the supplier. It is common for the recipient. If the supplier has to file the return, supplier has to file the return. If he has not filed the return, then the machinery should take action against the supplier so that he files the return, so that he pays the taxes. Why should action be taken against the poor recipient? So is the government, is the law saying that, look, I'm not able to collect from that guy, I'll collect from you by reversal, and there ends the matter? It doesn't end the matter. If that is the case, we may as well say all provisions of supply and services should be under reverse charge mechanism. That would be even more easier. You will pay the GST under reverse charge and that's the end of it. But that's not the law. That's not the way it can be. GST should be implemented fairly and equally across the persons in the supply chain. Everybody must comply with the law. Now let's look at what is going to be the impact of all these things. The auto-generated statement shall consist of details of inward supply on which ITC is available to the recipient, details of supply on which credit cannot be availed by the recipient. So it will also tell you what you cannot take credit and what are the reasons. That fellow has taken the credit before registration. That fellow is default in payment of tax. That fellow has got a mismatch in his supplier filing. That fellow has excessively availed the credit. That fellow has defaulted payment of tax under section 4912 because there's a proportionate provision which I'll explain a bit later. And such other class of person has been prescribed. So very wide. So there is a possibility that you may not get your full credit even though you might have paid significant amounts of GST to your vendor. New 4912. Government subject to condition restriction can specify maximum proportion of output tax liability that can be discharged through a credit ledger. Now, this is another way of ensuring that ITC is killed. ITC is there. You have availed in 3B. It is also there in 2B. You're happy. Then the provision says, no, you cannot use it fully. You should only this much. So power is getting created through 4912. You may say, sir, that power was already there in 86B. Well, 86B did not have power through the act. Now they're giving power to that. So this is all backdoor. First make a rule, then discover that the power is not there in the rule, then go to the section and confer power. But all these things, why are we doing? We are defeating ITC. We never had this in Senvat credit rules when Central Excise implemented Senvat credit from the 1986 till 2017. We never had it in service tax credit when we brought it from 2002. We never had it in VAT credit. What has changed so much that we need to do this? That is something which the council should ponder, the government should think, because GST is working. GST has contributed significant revenue. Your 61% is significant. You should not upset the apple cart and not disturb the ITC, which is the life and soul of GST. World over, these provisions don't exist in any other GST law. World over, these provisions don't exist in any other VAT law. So why should we do something which is so different, which can have the impact of choking businesses? Now you may ask me how it will choke businesses. It will choke business by one simple thing. Non-compliance of vendor is not in the control of recipient. So it will have a huge impact on business. So what will business do? A bigger business would take a very selfish call. In their sense, they are right in taking that call. They will say, I don't want to deal with you. You are not a person who is not filing returns. I won't deal with you. Which means there is a potential set of businesses who would lose businesses because their buyer will not going to buy. Second, buyer will be forced to buy from some business because even though they can take such a call and say, I will refuse, the material is significant. You can't afford not to have the material. It is not as if everybody in the country is complying with high level of tax payments and therefore everybody is in the system of taxation. If that is the case, you don't need the provisions like 206C and 206A or provisions which verify whether he has filed the return or not. You don't need provisions which says that in income tax amendment saying that if the donation is made to a university and the university does not file a statement, then the donee cannot claim the deduction. So you don't need such provisions. So when there is a possibility that things are not so hunky-dory, then we need to understand that businesses would get killed through some of these amendments, or what could happen is that you'll be forced to buy from those vendors, not take the credit, increase your cost and increase your price, and then contribute to inflation in some form or other. These two things can also happen. Now let's look at the supplier side. Why is he defaulting? There is so many number of small players. You will have a labor contractor, you will have a job worker, you will have a tinkering operator, you will have a painter, you will have some kind of small vendor, you will have a canteen contractor. There are so many players in the market. Now, all of them will not have that rich cash flows always. They will have labor problem, they'll have PF issues, they'll have direct tax problem, they'll have TDS due dates, they'll have bank pressures, they'll have COVID impact. In this kind of scenario, what do these suppliers do? They do what is known as cash flow management, if they have a efficient cash flow management. Otherwise, what they will do, whichever is top right, they'll pay. So when they're going to file the GST returns, they're looking at a 1 lakh GST liability and they have 60,000 rupees ITs. They can use that. 40,000 cash they're not able to generate. They can only generate 20,000. That is not enough. System will not accept. Unless 60 plus 40 is paid, the return cannot be uploaded. So that month return is not filed. Next month, he cannot file the return unless the earlier month's return is filed. He could not find 40,000 the earlier month. He already has a 20,000 requirement this month. He's not able to manage. Therefore, the second month return also he does not file. So he becomes some kind of a habitual violator because of the system not permitting to file the earlier month's return without payment of tax. 2 months is enough for him to close the business because the cash flows will be so significant. So what will happen? The system will automatically say, no, you cannot upload GSTR1 anymore. You're going to cancel your registration. And once that is done, nobody's going to deal with him. And that's the end of the story. So why are we trying to force exits? Now, what can be the solution? The solution can be that should we be so obsessed that the GST should have been paid by the vendor and immediately reflecting GSTR2? Look at the other provisions. Section 16.4 says you have time till November 30th after the March of 31st to claim the credit. You have a provision which says that you claim the credit and you don't pay the vendor within 180 days, you must reverse the credit. Now, all those things indicate that you can claim the credit. So why interestingly, or why insist that 2B should be the driving factor? Because 2B will change based on scenarios which can happen to the supplier. This I thought is a very, very significant point, and that's why I spent a little more time. Other amendments. Composition dealer registration can be cancelled if return not furnished for a financial year beyond 3 months from the due date. Go there, make him file the return and collect the taxes instead of closing businesses. Registration of other dealers can be cancelled if returns not furnished for such continuous tax period as may be prescribed. Now, can returns be uploaded without payment of tax? No. Can subsequent return be filed without filing earlier month's return? No. So again, we are generating forced exits. Forced exit means forced closure of businesses. Forced closure of business means shortage of raw materials. Shortage of raw materials means final product supply chain will suffer. Forced closure would mean employment losses. Then the existence issues. So we need to be very, very careful as to what we are doing. Some of these, you may think that, sir, these are required for this law. Income Tax Act is there in 1960, from 1961, 1922, 1961 Act. Have we been so successful in implementing all those sections? What was done was, it was a gradual change. Over a period of time, you introduced provisions in terms of prohibiting cash transactions. You brought 269TT, you brought penal provisions, you brought TDS in a wide range of coverage, etc. It has to be done slowly and allow it to grow. Otherwise, what will happen is that you may end up shaking the entire system. Some of the good amendments. Time limit for IT's availment, as I said, 30th November, following the end of the financial year. Section 34 dealing with credit notes, aligned with section 16.4, again 30th November. None of these sections made any sense because GSTR2 did not exist, GSTR3 did not exist. Therefore, 42, 43 and all gone, or been deleted. 43A is also gone. There's no necessary for your invoice, upload invoice matching, etc. as envisaged in 43A. Amount in electronic cash ledger can be transferred to electronic cash ledger for IGST, CGST. It's again a welcome amendment. Amount in cash ledger can be transferred between distinct persons also. Whether the next stage will be credit ledger also, maybe we have to see. Refund of balance electronic cash ledger can be claimed under 54. Some degree of clarity because there was some doubt as to how to claim this. So these are all welcome amendments. This again is a brilliant amendment. The rate of tax of interest has come down to 18%. Not only has come down to 18%, it is retrospective effect. And most importantly, ITC wrongly availed and utilized. See, it's very important. We need to understand that ITC availment at best is an accounting entry. The credit is there, but unless I use the credit and pay some tax, I'm not really using that credit. There is no real loss. Therefore, mere availment in my books, there is no loss to the government. But when I use that credit and claim a refund, or when I use the credit to pay another tax, and that credit was incorrect, then there is loss to the government, which is what they've said, wrongly availed and utilized. And this is retrospective from 1/7/2017. This again is an amendment which is probably pushed by the states, and therefore it came through very quickly to GST Council. Service by of grant of alcoholic liquor license against license fee application is neither supply of goods nor supply of services. Notification was there in 2019. They are now giving retrospective effect from 1/7/2017. But if somebody has paid the tax, so be it. The collection remains. You cannot ask for refund. So these are some of the massive, major changes. I would say there are some minor changes in the context of excise duty, which is going to change as far as unblended petrol is concerned, but not now. It is much later. So I don't have to talk about it till at that point of time. So I once again thank the Institute and the SIRC for this wonderful opportunity. And thank you all for a very patient hearing.
Thank you, sir. Before we move on to the specific questions on direct tax and indirect tax, probably like today, the gap between the direct tax and the indirect tax is getting closer and closer. So there is no watertight difference between a direct tax and indirect tax. Probably the government is moving towards compliance. So you beautifully explained about the cascading effect of the input tax credit and its effect. So probably it has an equal effect on the compliance in terms of filing your returns, etc. On one end, government is encouraging the startups, new companies and all that. And on the other hand, we have the ease of doing business and the n number of compliance. So basis your experience, do you think that Indian climate is ready for this amount of compliance? Can we actually run along with the expectations of the government?
See, I would put it like this. I think somewhere the changes are happening in silos. The government is truly a visionary government. If you look at some of the speech announcements that was there, we are talking about gaming, we are talking about amusement, we are talking about entertainment, we are talking about NFTs, we are talking about rapid urbanization that is going to happen in another 10-15 years. We're talking about a high-level committee that deals with that in terms of so many things, and looking at startups, looking at new vistas, looking at unicorns. We are doing a lot of stuff. I'm not denying that, and the government is definitely doing a hand-holding process and trying to help all these people. But what happens is that the other silo separately works on machinery provisions and procedure, etc. They don't marry. So you suddenly find that there is an increased amount of data compliance. There's an increased amount of information that is sought. For what purposes, we don't know. So, for example, there are provisions which say that, look, we are not able to track this transaction and therefore this section is being there. But TDS is already there. TDS already tracks all these transactions, but you have additional provisions coming in like that. So this amount of information that is being collected is for what purpose? So much of filing that is being done is again for what purpose? For example, Bhupathy was mentioning about how this film producer makes a payment of more than 50,000, and that scope has been amended to cover various categories like content, media, etc., or event managers, etc. Now, all these payments would have attracted TDS. Either 194C or 194G would have come into the picture. So there is always an element of TDS that is there. So that would have given that data. Why this additional compliance requirements? So what happens is that when there are so many paperwork that is required, so much of compliance requirement that is there, defaults are inevitable. And defaults multiply, defaults become humongous. And at a point of time, you stare at those defaults and then you can't even rectify that because everything is system driven, everything is technology driven. Unless this goes in, that cannot go in. So it is kind of a chakkar that people are getting into. Somewhere we should completely, there was an observation saying that how we have got rid of outdated acts. The finance minister made a statement saying that how nearly 1,000 legislations have been just scrapped. We again have to relook at and find out whether so much of forms are required, so much of compliance is required, whether for GST or for the purpose of income tax, and then try to make it as simple as possible.
Thank you, sir. Bhupathy, sir, what would be your opinion on this?
There are two ways of looking at it. One is any changes which is made, if you wait for a perfect execution, perfect performance from the participants or from the taxpayers, it is very difficult to implement. Even in smaller organizations, if you want to introduce a new scheme in the way of functioning, and if there are people in the organization who got used to a particular level of comfort level of working, bringing a new thing will definitely dislodge them, dislocate them, and there will be resistance also. So what is happening here is, I agree with Vaitheeswaran saying that it is overdose, definitely overload of information. But certain things, one thing which he was mentioning is there is already a TDS provision why these event managers and all have to file them. But the issue is when there is a TDS provision, the TDS is not done. If the TDS is done, then there is a track of it. If the TDS is not done, then there is nothing, it is coming on record. Therefore, what is happening is more and more these type of documentations and regulations are brought in, having in mind those few people who are not complying with law. And because of that, many sincere, honest, very hardworking business community people are affected. So there is an overdose. Somewhere we cannot do away with it, but I think there is a good case for reducing the information which the government is asking for. But now the difference is between the GST, they both are getting reconciled. As you said, both are getting reconciled. So for the information from the GST department flows to the income tax department, from the income tax department, vice versa, it comes to GST department. So to track all these transactions, they have the system, and they have got the algorithms working in the system also to trigger those sensitive cases which they feel that the income has escaped assessment. That trigger is working very well nowadays, and they really focus on cases where income has escaped. Yes.
You're muted, sir.
Sorry, thank you, sir. We'll move on to the questions. So first, I would like to take the direct tax questions. So obviously, as expected, the first question is on the updated return. So just clubbing 3 questions together. The thing is, the question was like whether updated return is over and above the revised return. The second part of the question is the tax, the additional tax which is paid, is it on the tax plus interest? So 234A, B, C. So is it the additional taxes on tax plus interest? The third part, third limb to it is like from which assessment year is this updated return applicable?
First part is whether you have to pay the additional tax on the tax and interest. I will put 2 scenarios. One is a person has not filed a return at all. If he has not filed a return and he wants to file a return now, and the entire tax he has to pay, plus interest on a 234A, plus interest on a 234B and C if it is applicable to him. As I told you, if he's a senior citizen and if he's not having business profits, advanced tax provisions are not applicable. If he is not a senior citizen or if he's having business income, he has to pay advanced tax. So interest for non-payment deferral of advanced tax. And if you have not filed the return, including the fee under 234F, 5,000 rupees which you pay, all put together, you have to pay 25% additional tax or 50% additional tax depending on the year in which you file. If you file it within 1 year, you pay 25% of the aggregate amount. If you pay it within 2 years, you have to pay 50% of the aggregate amount. This is one aspect. This is one. The third part of the question, what did you ask?
From which assessment year is this?
It's applicable from this year itself, because the finance minister also, while giving an explanation, she said that for the year ended March 19, 2 years from that date. So by 31st March 22, after the bill is passed, it takes effect and it can be done from this year onwards. From the day it's passed, it is immediately coming into force.
All right, sir. Thank you. So the next question is, how long is the profits exempt under Section 80 LA?
1 minute. I'll take some time to answer this by
Go on to the next one. Again,
part of an amendment. That's not part of the amendment.
Yeah, sure. So is there any threshold for that 194R, the perquisite on the business?
Perquisite 194R, is it?
Yes.
Yes, right. I tell you, you could
So
go
I
on.
understand this is like, understanding the provisions and presenting itself. Usually like Bhupathy sir and Vaitheeswaran sir, as they said, they do it on the day of the budget, where it is like one of the few occasions where Brahmaya Hall is overflowing. And today we have about, we had about 750 and now we had about 600 people watching. So double the strength of Brahmaya Hall, thanks to technology. Probably the questions specific to the rate limits and the forms per se, like we can take it up later, sir, not a problem.
Okay. Right.
So there's one question again. Is there any rationale behind reducing the time limit for filing the return? So in terms of 206AB and on the TDS provision, so that returns filed is reduced from 2 years to 1 year. Is there any rationale behind it?
Because technology helps them. No, they are able to process the return on the day you file the return. When they are able to process, and then the time limit, the entire process getting accelerated. I think there is every reason why they should make it reduce the time limit. There is nothing illogical against it. It's a good amendment, I would say. Because have you not received returns filed for this year, and immediately within 24 hours, within 48 hours, we get the process done. We have some glitches in the utility, in this software, but once that gets settled, I think everything will fall in place. So the need for giving 2 years time and all under the present fast moving country and economy is really not required.
Right. Thank you, sir. Vaitheeswaran sir, there's a question on definition of the digital assets. So this budget, we are talking about crypto and the Bitcoin. So there are two parts to this question. So one is, what is digital currency issued by RBI and what is Bitcoin? And one person had actually asked, like, does the digital asset include the videotape material, the content in the CD, etc.? Could be a movie, could be a song and all that. So can you just throw some light?
Yeah. See, first of all, we are only going by the statement of the finance minister as far as RBI is concerned, where she used the phrase, it's a digital rupee. And my gut feeling is that they would not have used the word digital rupee unless they were very clear that this is just a manifestation of the hard currency. So, and some of the statements which have come subsequently from the finance ministry and the revenue secretary seem to indicate that they are not endorsing any other currency except this currency. So it's going to be interesting to see whether the banning of cryptocurrency transactions as contemplated in one of the agenda items in the Lok Sabha before the budget session would still go through, or the taxation of 30% on that through the provisions which Bhupathy sir explained would indicate that there is some kind of soft peddling of that kind of legislation. My answer will be twofold. The way I would look at it is probably crypto assets in the way it is structured would continue to be taxed, and they would love to take the revenue out of the transaction. But cryptocurrency transactions or doing something using cryptocurrency as a medium of transaction may not be looked at very favorably. In fact, I would say cryptocurrency has to be handled very carefully, because that has the potential to become the next black money. Because cash has become otherwise in terms of in digital versions. Therefore, there is every possibility, and already the black web is well known for this. So there is a risk potential of a country which can simply say that we'll also encourage this currency. What happens if public prefer this currency over the rupee? You'll have run on the rupee. You'll have run on the bank. You'll have people moving their fixed deposits and other monies from banks to other safe havens. So I don't think the government would take such a big risk and follow out an alternate currency. See, a country like El Salvador could issue an alternate currency because they found that their currency was not doing very well against the dollar, and they found cryptocurrency was good. So they floated their own currency. But India is not in that kind of a position. But as far as the asset definition is concerned, it has been very widely structured. NFT is only one methodology. There are other ways which you can create. There are units that are being floated around using cryptocurrency. Every kind of asset is well defined in the provision. They seek to tax it. But it is going to be a nightmare implementing it, let me tell you, because the way these transactions happen, jurisdiction is going to be one of the biggest challenges. Why we are aware of the Wazir and other exchanges that operate, there are so many other ways you can do transactions involving cryptocurrency and crypto assets. So who is the assessee? For example, in income tax, We had the Vodafone case which went up to Supreme Court on the only simple point that the non-resident located outside India did not deduct tax at source in respect of income accruing in India in respect of a transaction in NR and NR. Well, that kind of dispute that can happen for the context of 185. Imagine the kind of issues in the context of cryptocurrency when somebody is sitting in Russia, somebody is sitting somewhere. There are different people involved in this entire trend. There is a miner who mines this. There is a person who processes this. There is a person, each person gets some degree of revenue in this transaction. So the gain is not the only one. You have to pay somebody who has contributed to this chain. There are X number of crypto coins or cryptocurrency. That is why it has got so much of value, because you cannot print more than that. You cannot generate more than that. You cannot mine or you cannot mint more than that. So that being the case, it is not going to be an easy exercise even to tax this. So what we will end up doing is that we will tax some transactions. We may not tax some other transactions. But interestingly, they completely forgot that if they could amend the Income Tax Act, they could have really amended the GST Act. Because if you are now saying that the gain is possible to be taxed from income tax purposes, and you're recognizing that there is a transfer, there is a consideration, etc., then what is the treatment in GST? Is it supply of goods? If it is supply of goods, how are you going to tax it? Or are you going to treat it as a supply of service? No answer. Obviously, it is not currency because government has said you're not going to declare it as a currency. So it's going to be very interesting as we go forward. Not easy to answer questions as to whether download will be treated like that, but I would take a position that download is definitely not cryptocurrency. Cryptocurrency is much more than what you're talking about as VCDs or things, etc. It's some kind of a meta disk format with a numerical description, and that is a unique one. So, for example, if you have a painting, that painting can be reflected in one kind of a crypto format and a crypto asset, and you can call it non-fungible token as NFTs, and that will be just a set of unique numbers as well as a particular imprint. Now that would be tradable by itself, and there'll be only one such item in the market. So there are even more bigger issues as to what is the royalty treatment involved, whether royalty is payable to the underlying owner. All those things are bigger issues.
Subhashini, as far as the first question is concerned, the 80 LA for how many years? It is for 10 consecutive years out of 15 years.
All right.
80 LA. And the other one, threshold limit under 194R is 20,000 rupees. Up to 20,000 rupees, you need not deduct. About 20,000, you have to deduct.
Excellent, sir. So one question in continuation for the crypto. So just that, like all other gifts to a relative is exempt. So will that include cryptocurrency as well?
Yes. Yes. If you are gifting to relative, it's exempted. All those things, they have not changed. That continues. They just added this particular clause.
All right, sir. So whether long-term, the next question is whether long-term capital gains on subcharge cap is applicable for TDS for sale of property by NRI?
By non-resident.
Yes.
Yes. Yes. Even for non-residents, the same surcharge. They're picking down the surcharge to 15%. It's not that for them the higher surcharge is applicable. It's not like that.
Great, sir. Thank you so much. And that's all from the questions desk. So as far as direct taxes and indirect taxes are concerned, we are definitely moving on to a kind of compliance mode. So despite the fact that individuals might have slight disappointments in terms of all the WhatsApp forwards and all that, so there is no change in the individual taxation. There are definitely other benefits which are brought in terms of the capital investments or other benefits to encourage employments in terms of startups, etc. And overall as a budget, so we see a lot of investments in terms of infrastructure, etc. And on the other end, we have numbers on fiscal deficits, other things. So do we really have that amount of money, and how do you look at it as a budget as a whole, like in terms of investing in the capital infrastructure as a developing economy?
Yes, I think the government has done its homework quite well, in the sense they have identified ways and means of, and they're simultaneously accelerating the disinvestment, although it has not gone as per the plan they envisaged last year or the last 2 years. Anyhow, they are putting the legs on the gas pedal to accelerate it. Things will happen, will fall in place. Therefore, the funds mobilization is the correct thing. And when so much of tax is being collected, for them to reduce and give small concessions to people is really not required. But for us, the MSME sectors and employment generation, they have not done it through the Income Tax Act or through the GST model. They have done it through other means. The type of funds they have allocated for various projects. And if you see the newspaper today also, all the newspapers, I had the opportunity of going through most of the newspapers, which says that the allocation of the resources to various essential requirements of the country is done in a proper balanced manner. Therefore, it's the right thing. But having said this, I have 3 points which I was projecting in some other forum, and I thought I could share these points with you. Today also, the disturbing experience we have, whenever a property is being purchased or sold, there is, even today, continuing a cash element. There is a cash element of it, which is an open secret. I'm not saying anything which is known only to me. It's everybody knows about it. If that is the case, why is it so happening? It is happening because the stamp duty on the registration is very high. And the purchaser, there are cases where the purchaser is having only official money and the seller is, in order to reduce the stamp duty, there is a possibility or a tendency to reduce the registered portion and pay the balance in cash. So the government should address the proposal of reducing the stamp duty. Now you would listen to the finance minister's speech. He said that the property documentation process is going to be simplified, and there's going to be one document anywhere in India you could register a document. All these type of statements were made. Maybe it's all in the primitive stages. If such type of thing happens, and if the registration charges stamp duty is getting reduced, the cash element in the property transaction could be reduced. Point number one. Point number two, I really have a problem regarding the non-resident deduction of tax on the sale of a property by a non-resident. If a non-resident is going to sell a property, the purchaser has to deduct tax at source as 20% plus surcharge on the sale consideration, not on the capital gain, on the sale consideration. And he has to comply with the TDS formalities with which he is not familiar with. So this creates practical problem. And we have personally analyzed about 20 cases the last 2 years where non-residents have sold the properties, have capital gains, TDS is there, they are claiming huge refunds. So it is high time that the rate of TDS on the sale of the property, instead of 20% plus surcharge, it should be a good case for reduction of the TDS on the sale of property. Most of the cases, it has resulted only in a refund. Why should they pay this much of tax and ask for a refund, which is increasing the administrative process of the department? This is the second point. The third point is, today, if I incur some expenditure for my personal work, not for my official business purposes, for personal work, say I appoint a contractor for doing some civil work at home and it exceeds the threshold limit, I have to pay GST. Now that GST I cannot take credit because I've not used it for my business. So what happens is GST. I understand in certain other countries wherein the GST has been paid in this fashion, the GST credit can be taken against my income tax liabilities. I was given to understand that Canada has introduced this. Whatever GST I pay for my personal thing, which I cannot claim credit, I could claim it because I don't have to pay GST. So if that is the case, I could claim credit against my income tax liability. If that is the case, then more and more people would be GST compliant and the collection way of GST would improve. So these three suggestions also, if it could be, echoed at the right forum,
yes,
proper
yes,
manner.
Definitely, sir. We'll take it forward, sir.
Okay.
Madam Subhashini, please note down.
To your question,
Yes,
to your question with reference to the direction of the budget and where it stands,
Yes, sir.
my answer will be like this. While I have expressed my concerns and the issues that are hovering around in the form of a dark cloud as far as GST credits are concerned, and those issues are quite serious from a business perspective and a country perspective, I cannot take away from the fact that the direction that the budget has taken from an economic perspective is brilliant. you look at any side of the way the allocations have been done, whether it is road infrastructure, we're talking about 25,000 kilometers by 2022-23. That's huge. 25,000 kilometers by one year is something phenomenal. Imagine the kind of employment that can be generated. Imagine the kind of vendors that can get benefit. There is also one more aspect of the budget. It said that people who are dealing with the government will get into an invoice upload, whereby they will get the payment by tracking the invoices by uploading that directly. Now that is again eliminating so many people in between, and you're getting transparency in the payment mechanism. So this will all augur very well in terms of employment, in terms of cash flows across businesses, as well as generate the necessary impetus for the country's growth. We're talking about railways, we're talking about 400 Vande Bharat trains in 1 year. Unbelievable levels of growth. We're talking about logistics parks, multimodal logistics parks. We're talking about road infrastructure, rail infrastructure. We're talking about river linkages. So these are all something which will definitely augur well for the country. So the thought process is very much there. The economic drive is very much there in the budget. So I would say from a Part A, Part B perspective, since our analysis is largely on Part B, we are looking at some of the Part B related provisions and discussing it. But Part A is something at a different level. And I would really give tremendous credit for the government to look at the entire exercise from a long-term perspective and set the country back on rails in terms of its growth, and probably look at that $1 trillion achievement which we're talking about. And last but not the least, to Bhupathy sir's point, that some of the countries have this advantage of GST credit being used against income tax liability. It will also increase compliance for two reasons. By very nature of humans, when you're engaging a personal contractor for something and that contractor says, I'm going to charge you 18% GST, you tend to look at whether that can be reduced in some form or other. Or that is an inclination which drives it, because the 18% is a cost. What you paid is 1 lakh, it's become 1,18,000. So it drives a lot of people to look at, to encourage, or even have a cold or have a Nelson eye towards this unethical practices. So that would definitely change if you're able to mine this credit. So either that amount should be refundable to you at least in part, or it should be set off against your income tax. And even I would go to the extent of saying that businesses which have excess GST credit because of their nature of businesses, GST credit must be transferable by like TDR, like transferable development rights. If GST credit can be transferred, then that will augur well for the business, as well as government will also get some revenue.
Yes, that's the extension of the idea.
Right.
I have one small clarification from from both of you, sir. From the common man's perspective, what would be the percentage? Which revenue should be more, like income tax, direct tax, or indirect tax? From a common man's perspective, sir. Overall revenue.
I always used to say, the serious part of it I will tell first, and the lighter part I will come later. The first serious part of it is the indirect taxes is something which is paid by the common man. Whereas direct taxes, those people who generate certain levels of income and then they pay. Therefore, asking all the people, I would say that indirect taxes should be less and the direct taxes should be more for a common man. This is how it should be. But ideally, it is not working out that way. That is point number one. The lighter side of it is, somebody was asking a question in a forum like this: what exactly is the difference between direct taxes and indirect taxes? The person replied, direct taxes is you asking me money and I'm giving it to you. Indirect taxes searching my pocket while I'm sleeping. So we really do not know how much amount of indirect taxes we are paying in our day-to-day expenses. It goes without our knowledge. We don't feel it. Every item which you purchase, there is an indirect tax. Even an ordinary person who buys that has to pay that. So definitely the amount of indirect taxes should be less, direct taxes should be more, but that is not happening for so many reasons. I'm not able to guess. How to implement it is a question.
Sir, I fully agree. Indirect taxes are definitely regressive, and direct taxes would do well for the country. And not only that, you are absolutely right when you say that it pinches you in so many ways. And I think the GST collections of this significance thanks are also due not to only to the businesses, but to the consumers.
Yes.
Ultimately, the consumers who pay the tax when they buy one plate of idli in the restaurant and pay 5% and come out. Therefore, they contribute significantly. So if you are in the 30% bracket, and let us say you're also in the surcharge bracket, you are paying 33% income tax. And if you take an average GST of 18% across goods and services that you procure, you're contributing nearly 51% by way of taxes to the government. So somewhere we should look at it from a citizen's perspective and relook at our revenue balance and also bring down the indirect tax rate significantly.
Thank you, sir. Thank you very much, sir.
I think more all this direct tax and indirect tax per se, the shift will work only when all of us are into that compliance mode. So if we start looking like where we can save taxes, then it is like indirect taxes are better because you don't even think, like Bhupathy sir said, like we don't even know how much we pay. And government is actually looking at that. So, probably if we are into a compliance mode where all of us comply with the provisions of the direct tax and we truly contribute.
Subhashini, the answer for that is other countries have achieved it by making direct tax laws extremely simple without deductions and a simple rate, which will drive us all out of profession.
I think that is a trend which is happening because
Yes.
you will find more and more the compliance work is coming, and with the result, it could be done by technology, it could be done by people with lower abilities, and we as a profession may not be required to do that work at all. So we have to have a relook at our new professional opportunities and
Yes.
according to the requirement.
This is already indicated by World Economic Forum report, sir.
Okay.
2 years ago, the highest job loss professions are identified. Out of around 27 professions, we are standing at the 5th position. Because of automation, our traditional practice and compliance practice will go away. That is one report. And recent, this January 22, there is a report. Why I asked that question of indirect and direct taxes. 84% of the population of India during 2021 have their incomes reduced drastically in this 1 year alone. So that impact of that already is there. So indirect tax impact, can it be mitigated through this process, or should this be brought to the notice of the government? That was my concern. So I asked these two questions.
Fair point,
Excellent.
fair point.
Yes, sir. Thank you very much for your reply, sir. We are very satisfied on that.
Thank you, sir.
Madam Subhashini, anything else? What's there?
Yes, my answer probably like yesterday till today, every person in the country turned economist. So everybody had their own opinions. Thanks to media, as and when the FM is reading, probably like they are giving their own interpretations. But probably we from SIRC, I think we did the right thing to give the right perspective to understand and analyze the provisions in the right way. I think we have done justice to it. Over to you, sir.
So thank you very much, madam. And today's program on budget, it's a opening innings for this financial year. I can say a great job done by two stalwarts, sir. From the bottom of my heart, a big thank you for both of you, sir. Both Bhupathy sir and Vaitheeswaran sir. Vaitheeswaran sir, I've been listening to you for last 30 years. Even you have visited my small place, Bellary in Karnataka. Thrice on indirect taxes, including this service tax, and Bhupathy being my teacher.
I have a small issue. Why do you call it small place when the entire steel is inside your mind?
Yes, sir. It is small place with big people, I can say.
Sir, he steals our hearts and makes us come there.
One of the small places which the company there has got an aircraft to fly people to their company and drive. Small. I think industries in Chennai do not have that, but the industry in Bellary has that.
Yes, definitely, sir, definitely. And this technology has made us to connect ourselves. And with today, it went at one point of time, it was 1,000 attendance. It would not have been possible at Brahmayal. So hats off to your, the name makes difference because Bhupathy sir is there, Vaitheeswaran sir is there, they are there. I am not keeping good health, but you made me to sit here by forgetting my illness, and I am so happy that I am part of this. So hats off to you on behalf of SIRC, sir. And also I thank my chairman in absentia for conceptualizing this program, even though it's a routine program, and for doing additional flavor. I definitely should, I will be failing in duty if I don't thank Suhashini. Thank you very much, Suhashini madam. And also I thank the back office, and also Mr. Selva, the technical hero for us, who has made all these things possible, and also back office of SIRC for doing this program so successful and so widely accepted across the South. So thank you once again, Bhupathy sir and Vaitheeswaran sir.
Thank you very much.
Thank you, sir.
Take care.
Thank you.
Take care.
Thank you. We log off now.